Welcome to the AWA Market Minute, breaking down current economic, financial, and political events that impact today's retirees. Our investment committee performs hours of research and analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring investment advisors Jaron Monk, Mason Page, Chief Investment Officer Scott Hoxer, and your host, founder and CEO Paul Coles.
Well, hello everyone, and welcome to today's episode of our AWA Market Minute. As always, we're excited to be here with you today. I'm Paul Coles, and with me is Scott Hoxer, our Chief Investment Officer. Just by way of housekeeping, the information that we present is always intended to be educational and informative and entertaining. It's not designed to be specific advice to you. So please, if there's anything that you want to talk about based on the discussions we're having today, come and talk to your team here at Alliance Wealth Advisors. Also, the information is accurate as of the time it was prepared and presented. And so with that housekeeping item, Scott, I want to dive in to today's topic. Earlier this year, I had an opportunity to meet with an individual who we were referred to, whose husband had passed away. And she was going through the steps of settling the estate and trying to kind of figure out what her financial picture was going to look like. That's such a hard thing for an individual to have to endure. Not only are they enduring the emotional loss of their companion and the love of their life, but then they're also enduring some of the emotional trauma that comes with a financial change and shift, and Social Security gets cut in half, pensions can be lost, and this individual was trying to figure out how to replace that lost income with the reserve assets that they did have, the investable assets they had, and they were lucky enough that they did have some reserve assets, and so we sat down and tried to help them figure out exactly what they had, and there was enough money there that they would be able to generate some income and to replace the lost Social Security and lost pension. But as I went through and reviewed these assets, I found that most everything was in banks and credit unions, savings accounts, and CDs and money markets, and et cetera. And so I began to kind of try to understand kind of who this individual was. As an advisor, we practice what we call empathetic understanding, and we try to really put ourselves in the shoes of our clients so that we can advise them better from their seat. And what I learned was that her and her husband had been a business owner, and most of their money, these reserve assets, were the result of selling this business. And she indicated to me, I when we go to generate income off this money, I don't want to own any stocks. And I said, okay, I'm all ears. Talk to me about, why you don't want to own any stocks. And she said, well, that's where you can lose money, and I don't want to be in that position where I can lose any money. And I said, fair enough. I said, just walk me through maybe kind of where you arrived at that conclusion. And she said, well, it's really just what people have told me. You can lose money in the stocks, and so I don't want to own any stocks. And I said, okay. So if you don't mind, I'm not going to push you, but I do want to educate, because I do feel that sometimes people make decisions based on emotions and not information. And so let me just take a minute and do some education. And she said, yeah, I'd be fine with that. So I explained to her, I said, even though it sounds funny, you've actually already owned stocks. And she said, explain. I said, well, you were a business owner, right? And I said, every year, your business generated revenue. And after you paid for the expenses of the business, the operating costs of the business, in theory, there was more revenue than expenses, and you guys made a profit. And she said, of course. And I said, and then as the owner of that business, you would take that profit in the form of a dividend. And she said, yes. And I said, so you were the stockholder of that business. And she said, okay, I guess I never thought of it that way. And I said, that's how that worked. You were the stockholder of the business, and every year if the business sold more things and made more revenue than the cost of running the business, you were entitled to some of the dividends and earnings of that business. And she said, that makes sense to me. And I said, now let's apply that more broadly. I said, let's think about Home Depot. Home Depot sells stuff every year. They're generating a revenue, and they have operating costs. And if their revenue exceeds their operating costs, then that difference, the profit, the shareholders of Home Depot, the owners of Home Depot, are entitled to the revenue, the earnings. And she said, yeah, but who owns Home Depot? And I raised my hand. I said, I do. And she said, wait, you can own Home Depot? And I said, yes, you can own Home Depot. And you're entitled to the earnings or the dividend if Home Depot is profitable. And she said, oh, okay. And I said, what about McDonald's? McDonald's sells stuff. And every year, if they sell more stuff and make more revenue than the operating costs of McDonald's, then there's going to be a profit. And they take that profit and distribute it out in the form of a dividend to all their shareholders, the owners. And she said, now I suppose you're going to tell me you own McDonald's too. And I said, yes, I own McDonald's too. And I said, see, you can own, just like you owned your business, you can own lots of businesses. And you can diversify out and own so many businesses. And if those businesses make money, and it's more than their operating expenses, they'll share that with you in the form of a dividend. And she said, I wish somebody had explained this to me years ago. And I said, well, I'm glad you got to the table now. Now you understand how this operates, and it's a lot less scary than maybe, we feel that emotion when people say, oh, you're going to lose, you can lose money. So long story short, we feel strongly that a little bit of information goes a long way when it comes to owning stocks and education on specifically dividend type paying stocks. So with that backdrop, Scott, let's go ahead and introduce today's guest host.
Sounds good, Paul. So super excited today about our guest. So Mike Andelman is joining us today. Mike is the co-portfolio manager for the Dearborn Rising Dividend Strategies. He conducts equity research with a focus on healthcare and technology, and is a managing director and a partner at Dearborn Partners. So super pleased to have Mike with us. Mike, thanks for joining us.
Thank you. Thanks for having me.
Hey, Mike.
So let's maybe just kind of kick things off today, Mike, with maybe just a brief overview of the Dearborn High and Rising strategy, if you would.
Sure, absolutely. Thanks, Scott and Paul. And actually, Paul, your story about talking with the client is pretty valid because we own only dividend-paying stocks, companies that we're looking at that can grow their earnings and pay out part of their earnings as a dividend to the end shareholder. So we're only focusing on those type of things, your high-quality names that can grow their dividends in all types of markets.
Awesome.
And we've seen all types of markets here in the last 3 years. So with the pandemic thing in 2020, it's amazing that we're already 3.5 years from the start of that. It's been kind of a wild ride. That said, we feel pretty comfortable where we sit here in 2023. We had an ugly market last year, S&P down about 19%. Our strategy held up quite well after the rough market. And most of our companies, I think, were conservative at the beginning of the year. We're still seeing nice dividend growth out of our companies. And I'm sure we'll talk about interest rates here in our discussion, but the Fed has increased rates here quite a bit in the last year and a half ago, and we're finally, we think, in the ninth inning of that game.
Yeah, and I appreciate that insight, Mike, and I think it's important for our clients. Our client base is a lot of folks at or near retirement, and yeah, we certainly want growth in portfolios, but that notion of, with certain strategies taking a little less risk than the overall market really, resonates with both us and our clients. Maybe let's kind of zoom out a little bit and talk about equity markets generally. So July felt like a really good month. Markets were rallying and doing extremely well. August has maybe been a little bit bumpier. How are you feeling about equity markets and kind of the economy generally right now?
Yeah, sure. So, it's been a great first 7 months, call it, of the year, market-wise, and really a lot of the economic data we've seen. So, I mentioned going back to January, I think the market was pretty pessimistic, and economists were forecasting a recession and, a big slowdown in this country. We're just not seeing it yet. I call it an earnings pause this year. We had so much stimulus pumped into the system with COVID, with PPP loans and, stimulus checks. A lot of people weren't initially traveling. They were saving their money, most recessions, people run up their credit cards and savings rates drop. It was actually the opposite this time around, sorry. People saved the first 12 months. They weren't going on their normal vacation. And so then, basically back half of 21 to 22, you saw everyone spending, and of course, inflation running rampant all last year. Has increased rates to combat that. So that said, the markets, the S&P's up double digits this year. I think, at the beginning of the year, if I told you 7 months in, the S&P, the market would be up double digits, probably wouldn't have believed me, but here we are. So, we feel like the market is fairly valued here. We're not focused on what earnings are this year. We're looking at these companies on a 3 to 5 year basis. And, we're a buy and strategy, very low turnover. So, we have 25 stocks in this portfolio, probably 2 or 3 new names a year. It's not going to be 10 or 15 brand new names each year. If we're doing our job right, we're buying these at the right value, we can hold them 5 to 10 years, and you can't get the dividend growth out of this portfolio unless you hold the names. That's what we've done.
What kind of research and maybe walk us through the process that Dearborn applies to the selection process of when you say we add 2 to 3 names a year, that probably means you're dropping 1 or 2 names a year as well. Walk us through so our clients can maybe have a better understanding of what goes into the war room conversation of this stock is ready, how much time does it take before you're ready to kind of make that decision, and this stock is time to move on from?
Right, great question. So two steps really, Paul. The first is, when do we look at a name that we're interested in to put in the universe? And we don't have hurdles at Dearborn we don't have a screen that gets us down to our portfolio. We have analysts at Dearborn. We have 5 of us on the investment team. When we look at new stocks, something that pops on our radar, we go right to the balance sheet. We want to make sure a company has low levels of debt. If they do have debt on the balance sheet, it needs to be investment grade debt. We're not interested in companies with junk bond ratings. When the going gets tough, those types of names, the first thing to go. It's their dividend. So we're not interested in those types of things. So companies have to be at least $1 billion in market cap and pay at least a 1% dividend. Those are the 2 what we call hurdles for us to even consider a company. So once we do our research, we look at these names and we feel comfortable in a company that's growing earnings and cash flow, and thus their dividend, and that name can go into our universe and be a name we consider buying if it's at the right valuation. Then it goes through our whole valuation model in order to determine if the stock is undervalued or overvalued.
And just out of curiosity, that first hurdle, how many stocks would qualify on that first hurdle?
Yeah, the billion market cap and % dividend.
Yeah.
There's probably 400 or 500 names that are traded that hit those hurdles. For us, though, to go the extra step and say, do we feel comfortable with earnings, cash flow growth, and dividend growth? Our current universe is about 185 names. So about half of those.
Got it.
And so on the back end of that, Mike, as Paul mentioned, you've got new entrants, but then you have companies that will need to leave the portfolio. What kind of drives the sell decision on the back end? Because that's a super important component of portfolio management as well.
Sure. Yeah. Easy to buy a stock. It's hard to sell one.
Yep.
Number of reasons we could sell a name. First and foremost, we've got some companies that have been bought out by other companies. We have to sell that name, either cash or stock deals. Those we like because normally those are at a premium. Second reason we'd sell a stock or just trim a name. If it's a larger position in the portfolio and we feel like it's fairly valued, we may trim that name back to an equally weighted position. And then we'll add to some stocks in the portfolio that may be traded off that we like even more based on valuation basis. That's a quarterly rebalance that we do after we've digested all the earning companies each quarter. And then lastly, we'll have, and it hasn't happened much in the last 12 years since we've been running portfolios, is we'll sell a name if we buy one that we expect, upper single-digit dividend growth or double-digit dividend growth, and we see some factors in the stock where we think that growth may go. It hasn't happened much because the economy has been so strong prior to COVID, and now we are a pretty strong economy. But yeah, if we buy a name that we expect, a certain amount of growth, and we see some, elements of the company, some slowdown, maybe, core growth is slowing down. We typically have 2 or 3 names in our universe that we'd like to add in the portfolio. We won't hesitate to sell a name that we think might underperform our expectations when we put it in the portfolio.
That's awesome. I just want to maybe just add a little context just from our client's perspective for those listening here. So as you're thinking about your portfolio, your IRA or whatever that we're managing for you, we've got Mike and his team taking a pie of that portfolio and saying this slice of your IRA, we're specifically doing all this research and work and diligence on to pick the appropriate positions that fall within the criteria that Dearborn's looking for, and then you end up owning these positions in that portion of your portfolio. And it's such a powerful way to own good quality investments and own them directly inside your portfolio. So there's not a fund and a black box that goes behind that fund that our clients have to deal with. And we really appreciate Mike and your team for that.
And I think just to add to that, Paul, I think that's a super important concept because you in your story talked about like playing the market, and that's not what we nor Mike nor the other folks we work with are looking to do. I know Mike and team look at potential investments as a business owner would, as far as, hey, we want to own this for the long haul and we want to truly take an equity stake in this as a long-term play. And so I think that's an important distinction. Yeah. Kind of changing gears a little bit, Mike. We've gone through a pretty intense inflationary cycle. The most intense we've seen in the past 40 plus years, and we saw inflation get to near 10%. It's fallen significantly. Today's inflation print was around 3% and change. And if we look at where rates are forecast to go in the future, rates are actually forecast to maybe go down a little bit next year. How does a dividend type strategy like yours do in a declining rate environment?
Mm-hmm. No, good question. So yeah, I mean, our goal in this portfolio is to keep up with the rising cost of inflation. So last year that was tough. We had a decade where there wasn't much inflation. The 2010s inflation averaged less than 2%. And as you well know, a longer inflation average is 3 or 3.5%. So to have a CPI here, Consumer Price Index, in the 3s is not that abnormal, really. I feel like we've definitely normalized here with inflation. It was a tough 12 or 18 months, and that's why the Fed had increased rates. So what we look at, our risk-free rate in our models to pick our stocks is the trailing 12-month 10-year treasury. So we focus a little more on the 10-year treasury. Fed funds rate, can fluctuate quite a bit here, especially in the middle of the cycle or starting to cut, whenever that may be. We're really in the camp of we're probably going to see higher rates for longer than people expected. At the beginning of this year, forecast was for the Fed to cut rates by the end of 2023. That's now pretty much completely off the table. We expect, this might take longer for this whole Fed cycle to play out, but we do think we're in the beginning of them raising here. The CPI print this morning was weaker than expected, so there's a chance the Fed is done. But even if there's one more raise, we think they're ending the cycle here. So our view is on the 10-year Treasury, we may see higher rates now for longer. So while rates may shorten the curve, the Fed funds rate may fall. I don't think that will affect the 10-year Treasury all that much. We'll get to a more normalized Treasury curve where the term inverted, meaning short-term rates are higher than longer-term rates, is a very strange time in the market. But this is really Fed-induced, and I think 6 to 12 months now will have a much more normalized interest rate.
Very cool. Switching gears again, one of the areas of research that you guys specialize in is healthcare, right?
Yep.
And what is that landscape like, and what are some of the the research and what are you looking for to help identify potential companies to invest in that space?
Yeah, sure. So healthcare has been an interesting sector when COVID hit, hospitals were shut down. So we own a couple names, a couple drug makers, medical device company, and Medtronic. In some of our other portfolios, we look at Stryker. Very, very strange healthcare market, because the first 6-12 months, hospitals were shut down. They only had COVID patients. So a name like Gilead that's in our portfolio benefited from COVID because they had an antiviral for the virus. Now, other names, in the OR for regular surgeries, like a Becton Dickinson, which makes scalpels and other tools in the operating room, they're not recovering because people may have put off some elective surgeries the last few years, maybe needed a new hip or knee, and now people are getting back in the OR. As you guys know, there was a shortage of doctors and nurses over COVID, and they really had to shift gears. But now we're back.
It was a really bad time to be sick with anything except COVID.
Exactly right. Yeah, so I feel like back half of 22 and 23 is really just these companies getting back to normal in the healthcare space. So it's really been interesting to watch. But as I said, a couple names benefited initially, and a couple really got hit hard in their earnings for 1 year. But we were patient investors here. Same thing in the energy market. Crude oil went negative back in May of 2020. We didn't panic and sell our energy names. We just said, all right, what do these companies look like when we're back to normal? Some of these sectors took a little bit longer to get back to normal, healthcare being one of them. But yeah, the energy market's really leveled off, and everyone knows where gas prices are. We were paid to be patient in those names. We're starting to see dividend growth in those names.
Thanks, Mike. And maybe talking about another sector that you specifically focus on, and that's technology. And traditionally, we think about technology as more of like a kind of growth sector. You think about these as, hey, not paying out dividends as much, more reinvesting the earnings they generate in future growth. But there are some companies that are both technology oriented and dividend paying specifically. Maybe talk a little bit generally about how you identify good target companies in the dividend paying technology space.
Sure, absolutely. So yeah, our names in our high and rising portfolio are really kind of more of the steady Eddie technology names. IBM, Texas Instruments, and Qualcomm. So two chip makers, and IBM who acquired Red Hat a few years ago. So a lot can be talked about technology. This year, it's really technology names. The non-dividend payers are really driving the market higher. The complete opposite happened last year. A lot of these technology names that don't pay a dividend and are growing nicely, they got hit hard last year with the market pullback. When COVID hit, some of these big technology names were up 100, 200%. NVIDIA, Meta, and a couple of these that are top 10, positions of the S&P 500. The top 10 names in the S&P now make up 30% of the overall market, and those names really have driven the market higher. The names that we're focused on, IBM, Texas Instruments, Qualcomm, a lot of recurring revenue there. Like I said, steady Eddie. We're expecting mid to high single-digit dividend growth out of these names. And these names are a little easier to forecast. At the end result is this portfolio, that's lower volatility than the overall market. You don't want to own a name that's down 50% in a year. Now, you might give up 50% when it rebounds, but part of the reason the strategy was down, very minimally last year was these technology holdings held up quite well compared to the rest of the technology sector last year.
Maybe a follow-up question on that, Mike. So, your strategy is a domestic strategy. It's not an internationally focused, but some of these companies, like in Texas Instruments, IBM, et cetera, they have a global footprint. How does that kind of play into your analysis as you look at like their global footprint, the demand in other parts of the world? How does that kind of play into your calculus?
Sure. Yeah. Even though all of our companies are U.S. domiciled, we have about 40% of the revenues of our companies overseas. Europe, Asia Pacific, South America. The nice thing about these big multinational companies is they can go where the growth is. So we're not, even though they're U.S. domiciled, plenty of revenues overseas. So we kind of think of this, the world is flat, really. There's been a lot of talk about cost increases overseas. Some of these companies are now bringing production back to the U.S. Texas Instruments is in the middle of building a big plant. And so, they're going to go where the costs are the lowest, where they get the highest productivity. But as far as the revenue side, a lot of these technology companies have pretty good Asia-Pacific exposure, and that's getting back to normal here. And there's been a lot of talk about that in the last couple of years, especially with China shutting down all the time. So, what's nice about these multinationals is they can go where the growth is, and we do our analysis. A lot of times that's where a couple of percentage points of growth is coming from in these names. But for the most part, 50% of our revenues are in the U.S., which we feel like is really the stronghold right now in this world economy right now.
So just maybe some parting thoughts here as we zoom out again a little bit from even just the, just kind of your team, the market research that you guys perform. Are you guys in the camp that we're still a glass is half full, 2023 mentality, soft landing still in sight? What are some of the things that cause you guys to pause still?
Yeah, the answer is yes. We are glass half full here in 2023. We only have a couple months left here. We're focused on these earnings for 24 and beyond. So, we may see some volatility here in the last week or two as we've seen a little speed bump here, but really the market's been pretty resilient. Volatility is down. Really, it feels like investors have kind of learned to live with this market. And, the talk of recession, as we move forward every quarter, is going to diminish. We've never seen a deep recession in this country with full employment like we have and rising wages. So the consumer is still driving this market. And while spending patterns may slow down, you also have business spending that's still pretty strong. We still have 10 million open jobs in this country as well, so we have that as a backstop. We haven't seen massive layoffs yet. If we do, people can find jobs relatively easily here with 10 million open jobs here.
That's awesome. Well, Mike, we really do appreciate you taking some time to be with us today and our clients. And just kind of by way of wrapping it up for our clients, it's guys like Mike that do all this research and work and due diligence and analysis on the underlying positions that make up many of your portfolios, and having such close proximity to these resources really is such a value for us as a team, for our clients and their portfolios. And we just want to say thank you and appreciate all the hard work you put in to helping our clients in their retirement.
Thank you. Thanks for having me.
Thanks, everybody. We'll sign off now, and until next time, thanks, everybody. We'll talk to you next month.